Welcome to Everything Money. In this video, we will look at Zillow, an industry standard for buying and selling, appraising homes. We will teach you the financials and the fundamentals behind the company itself, not the stock ticker, and we will see if they're in line. We will head over to Trader Mo to see if people are trading Zillow at a faster pace. And in the end, by watching this, you will learn from us. You will learn about our software we're offering to you to get control of your finances, and you'll be able to fire your financial planner and invest for the future. I introduce you to Paul Gabriel. He will teach you how.
All right, guys, the reason we created this channel is I was sick of all these people creating YouTube channels who had no idea what they're doing with no experience and saying, I'm an expert. So we created this. Mo and I manage 9 figures in real estate businesses and stocks, no brainer. So this is our Everything Money software. We are looking at Zillow. So I go to the 8 pillars. I type in Zillow. It pops up, Z. So.
Now, Paul, this is just disguised as a home pricing site, but we learned, talking to some of our friends in the mortgage business, is that obviously they're gaining interest and selling off leads to other companies all over the country. So it's much deeper than it seems to the naked eye.
Of course, and they are growing. I like Zillow, but I feel like Zillow does a good job when all the houses in the area are very similar, right? So if you're in a neighborhood where there's a bunch of cookie cutter homes, as much as I hate to say that, that's where Zillow is probably very effective, where everything's the same. But look at something interesting, Seth. On February 12th, look at the stock price.
Look at that, $200.
Now look at it.
No.
So look at this chart right here. The most common comment we get is people looking at this chart saying, I gotta buy. And if I told you back then that 7 months later the stock would fall by more than 50%, what would you have said?
You said you're nuts. There's no way. This is headed to the moon. Moon rockets.
I'd say home prices are skyrocketing. Everything's skyrocketing.
Yep. If you had a house for sale in February and it took you more than a day to sell it, you were the worst. You had the worst house in the world.
Yep. Yeah, more than a day.
It was impossible.
Yeah.
So
what we're going to do is use our 8-pillar analysis, look at the fundamentals of the company. We will go through each step right now for you. Go ahead, Paul.
So guys, Zillow is a $22 billion company. In the last 5 years, it has made no money overall.
Uh-oh.
Right, so it has no PE, so that's an X. We want a 5-year PE of less than 22.5. Last year, it did 150 times its earnings. So its PE in the last 1 year is 150. 5-year return on invested capital, again, it's negative because they've made no money, and this is based on 5 years of profit and cash flow. Seth, here's the big one. Last year, they made money because they have a positive PE, but their free cash flow was negative.
What? How?
That's a very confusing thing. But guys, free cash flow and earnings over long periods of time should be very similar. But on a year-to-year basis, based on accounting rules and SEC rules, they can differ greatly. In the last 5 years, they've averaged a negative $87 million in free cash flow. And last year was negative 500 of that. So we're not off to a great start here. 2 X's because we want a return on invested capital over 5 years of greater than 9%. So far, 2 X's.
Are we buying the dip, though, Paul?
Yeah. Well, let's see how big of a dip we need to buy.
Okay.
So our third pillar is income growth. We want to see a 5-year income growth. 5 years ago, $964 in revenue. Last year, $3.97 billion.
Pretty good.
Yeah. So, guys, 4 or 5 times revenue growth, 4 times revenue growth. I like it. Next, we go to net income. We want to see growth in net income. Negative $43 million in profit. A profit of $147.
Okay.
It's a check mark because they went from losing money to making money. Pretty easy check mark.
How about shares outstanding? We want this number going down, and I'm certain they're selling off, Paul.
So guys, this is the biggest silent killer of stocks. When a company issues more and more shares, what this means is they are taking the pie and they are decreasing the size of your pie. Every time they issue, if you own 100 shares, you'll still own 100 shares. But if they increase the number of shares outstanding, your 100 shares buys a smaller and smaller percentage of that pie. This is killing you slowly, okay?
Do you like pumpkin pie, Paul? Mo, do you like pumpkin pie?
I don't like the texture.
You love it?
Love it.
Tastes
I
like
make
Jell-O.
an amazing pumpkin pie on Thanksgiving. I'll bring you a piece. Go ahead to shares outstanding, Paul.
185 million to 248 million.
No, it's bad.
So they've increased their shares outstanding by 33%.
Boy.
That's no bueno. Okay, so the next thing we do, guys, is one of the most important aspects of a company is, do they have too much debt? So we've decided, we've looked at in history, we take the 5 years of free cash flow, we multiply it by 5. Now here's the problem.
Uh-oh.
This is negative. So automatically they have too much debt based on this metric. So what you might want to do for a company that's growing quickly, that's losing money, you want to compare their debt to their revenue. Their revenue last year was $4 billion. Now, I don't know what's a reasonable number based on revenue. This is where you go in, and join our community and talk to people about what's a reasonable amount of debt relative to revenue. But here, what we normally do is we take that 5-year free cash flow, multiply it by 5, and we want their long-term liabilities to be less than that number. To find long-term liabilities, you go to our software, go to the balance sheet, go to the very bottom. They have $1.5 billion in long-term liabilities. Now, based on $4 billion in revenue, that doesn't sound like a ton, but I have no idea. I really don't know if that's a lot or not. You have to figure it out by doing more research on the company.
Mo, based on these metrics, why would anyone be buying this right now?
It's not looking promising, and it's funny, what came out this week, Zillow took a 10% hit this week, and it was because they stopped doing flips of their houses. They stopped acquiring houses.
That's right, you were telling me
which was about 49% of their revenue.
Oh my.
49% of their revenue?
It was nearly half of their revenue. So this is where I didn't know this about Zillow until this week.
Holy cow. And by the way, guys, if you want to learn that information, we have the news tab on our software where you can go there and see all the recent news on Zillow. But either way.
Pillar number 7 is that free cash flow we need, Paul. We know they don't have it, but is it growing?
Well, it's interesting, Seth. So free cash flow is cash from operations less your capital expenditures. The reason this is important is the company uses that free cash flow to pay out dividends, buy back shares, pay down debt, and make acquisitions. If they have no free cash flow,
they're not
they
doing
have
any
to
of
either
those.
issue debt or dilute you in order to do that by issuing more shares.
I see.
Those are the only two ways in which you either take on capital from investors by issuing more shares or you take on debt. One of the two has to happen. So we go to our sheet, and Everything Money Software is the only one that adds the line right here to the cash flow statement. Cash from operations, 5 years ago was $80.6 million. Last year was a negative 500. This is all over the board, Seth. Look at this.
Yes, I see it.
I mean, look at these numbers all across the board.
Crazy, up and down, positive and negative.
So let's go to the 8 pillars tab where it just recaps all of what we just did for you.
This will be a slaughter right here.
It's a slaughter.
It's a lot of red.
The 8th pillar is free cash flow average times 20 for a market cap, but the last 5 years is an average of negative 87 million in free cash flow, so there's no value to it. Guys, they do have net income and revenue growth. That is a very good positive. So this is already telling, here's the point. If it wasn't for me making this video, I would have already moved on from Zillow.
Yes, that's true.
Right? I just said, listen, let me wait for the company to get cash flow positive, get more stable, determine what's going to happen with this house flipping, and say, let's figure out what the company is really worth.
That takes a lot of patience and discipline, Paul.
And that's what we're trying to teach here on the channel is discipline and lacking FOMO. We don't want you to have a fear of missing out. There are 10,000 stocks out there to buy. Find the 20 or 30 that work for you.
It's astounding how much you can love a company and not be in love with its stock price. And Paul, let's not kid ourselves here. This was how much? I mean,
$200
$200
7 months ago, 8 months ago.
Gosh.
So
wait, who was buying? Yeah, it's astounding.
And everybody would have thought we were crazy with seeing that chart and saying it was going to fall in half or more.
Yep.
So guys, the next step is, and what's something that's very, very exclusive to our software is a stock analyzer tool. What this allows you to do is put in your assumptions, because every investment is based on assumptions, because we don't know the future, and it's the present value of all future cash flow. So we're going to put in our assumptions of revenue growth, our assumptions of share change, our assumptions of profit margin, and multiples to pay in the future, and it'll tell us if you want a certain return, here's what you pay. So I go and I'm going to do a 5-year analysis. I'm going to do only 2 assumption entries. Now, the revenue growth, look at last year's revenue growth. You know what? I can't even do this. You know why?
They don't have.
Well, they're going to drop their revenue from selling these houses. That's going to drop immediately.
Yeah, this is kind of one where it's almost not useful to do this, and it's more useful to dig a little bit more if you're interested.
But here's what I'll do though, Mo. I will still do the assumptions, and I'll just sit there and say, listen, let's assume they still kept flipping houses.
Okay.
It'll show you how overpriced this company is.
Good point.
So in the last year, their revenue growth was 10%, but they did 52% over the last 10 years. So I'm going to go 15 and 25%. Big ranges. Share change. Now, guys, look at this annual share change. They're going to keep issuing shares instead of taking on debt.
100%.
Because their comment's going to be, why should we take on debt that's with us forever? Let's just give these suckers really expensive shares that they want, and it doesn't cost us any money.
Especially because the stock looks cheap now.
Correct. So people think it's cheap right now. So I'm going to assume 8% and then 5%. Profit margin, I'm going to go 4 and 8, even though they had negative for a long time. Free cash flow margin, I'm going to do the same thing, 4 and 8. PE, guys, I'm going to go crazy. I'm going to go 20 and 30, 20 and 30, which is an obscene number. And I'm also going to do a 12.5% return. Why 12.5%? Because to me, if you only want a 10% return, which is the market, which is probably what the company is worth, then just put it into an ETF and save yourself the aggravation. So I want a reason to go buy this company. I hit the analyze button. Now, the stock is currently at $89 a share. Even at these high assumptions, guys, look at these price ranges here. 13 to 60 bucks, which means the stock is probably somewhere in the 40 to 50 range. So it's already fallen by over 50%, and I can't even justify that. That's how overpriced it is. And by the way, they're about ready to lose a lot of revenue from stopping flipping. So I look at this going, and I put in higher profit margin and higher free cash flow margin than they've ever shown. So I'm making major assumptions about the future. This is just telling me, using their stock analyzer tool, this company is overpriced.
If you've only ever looked at a ticker price to start making your investments and hoping they go up, you can utilize our software, which you can have right now, and Paul will tell you how to get a hold of it.
So guys, this software we created because our users kept seeing us do all this analysis and said, how do we get access to it so we can do our own analysis without waiting for a video to come out? So we made it. Now, this software includes the mobile app, so it's everything here on your phone. You have a community of over 6,000 people who you can talk to every single day. For those of you who feel alone that you can't talk to anybody about investing, you get daily exclusive content from Seth, Mo, and I. We post only content to users of the app and users of our software. You get real estate analyzer tool and all these other things that we're making on the site. All these things that are coming soon, you will get. And this is only 90 cents per day. So if you're serious about your financial future, 90 cents per day, if you could just increase your returns by 1 or 2% a year, go put it on our retirement calculator, and it'll lead to hundreds of thousands, if not millions of dollars in extra money for you over a long period of time. This is a no-brainer. Sign up for it either at everythingmoney.com, where you don't pay sales tax, or go to Patreon if you're more comfortable, but they double charge and they charge you sales tax. So the decision is yours, 90 cents per day.
If you want to trade Zillow at a faster pace, again, not a long-term buy and hold for 7 years, maybe you want to day trade it or week trade it, momentum, you can join Mo in the Bid and Ask Nation, that elite tier of traders in our community. Mo, what are people doing with Zillow? What happened yesterday? Look at, oh, there it goes.
Before we get into this, I want to point this out. This was on February 10th of 2021. They beat, this was 4 days before their epic collapse that they've had. They beat revenue by 48% nearly. They beat net revenue by 6%. They beat earnings per share by 48%. Then look what happened just a few days later. They ramped up, and then this is the start of their fall, February 16th. After crushing earnings, every outlook probably from them was the best thing ever, and that's what happens to you. So be careful, guys. But anyways, this is your ultimate dog stock right now. And what a dog stock is a stock that starts up here and it just falls right through the sweet spot, and then it gets to the bottom and it does nothing for a very long period of time. So the good news for you is you can throw a tracker share on this. Buy one share of this, keep it in your portfolio, look at it every single day. Eventually, Zillow will pop back up here in the sweet spot and you will be one of the first people to grab it. If you want to do something in a shorter term area, swing trade's actually looking pretty good here. They did have that 10% fall, but they are filling that gap right up. Coming right through the sweet spot on a daily chart, charging towards the 50-day moving average. This could definitely move up to about $102 per share, which is the 100-day moving average. So there's definitely different ways of going about this. If trading speaks to you, if pattern recognition speaks to you, join the Bid and Ask Nation, jump in with me, all my training videos, all the other people that are great traders in there, and this is the place to be, Bid and Ask Nation.
Paul, final take on Zillow. There's not much to even say, right?
I'm just going to ignore it for a long period of time.
Learn from us. Stick with our videos. This is language we're speaking, and you're going to have to watch a lot of videos. It may take some time, but when you get it, you can get rid of your financial planner, get a hold of your finances by using our software and our app. And in the meantime, it can result in millions of dollars of difference. Keep at it. We love having you on the channel. Make sure you fondle a thumbs up on the way out. We'll see you next video.